Good afternoon, everybody. My name is Tricia Shaughnessy. I'm the Postgraduate Programme Manager here in Cork University Business School. You're all very welcome to our third in a series of webinars that we'll be running throughout the spring. The next webinar takes place on Thursday, April 29th at 12 p.m. and will focus on the relevance of specialist technical training in today's current employment market. Past students will speak to topics such as big data, business analytics, data security, and their application in business, and what it's like to upskill by earning a technical specialist master's degree. Today's event is on investor and regulator perspectives on negative interest rates. I will introduce you to one of the finance programs we have here in CUBS, the MSc in Finance, Banking and Risk Management. We'll speak more of the program entry requirements later, but for now, I'd like to introduce you to our panel. I am delighted to be joined by Dr. Fergal O'Connor, the Co-Programme Director of the MSc in Finance, Banking and Risk Management, Professor Niall O'Sullivan from University College Cork, CUBS, John Twomey, who's the Head of Research at Abbey Capital and a past student of the MSc in Finance, Kathryn Prendergast, the Chief Risk Officer at BlackBee Investments Limited and the incoming banking supervisor at the European Central Bank. Kathryn is also a past student of the MSc in Finance. So just a little housekeeping before we kick off. Feel free to pop any questions you have in the chat function, and we'll do our best to answer them all during the webinar. If we don't get to the questions, they'll be answered directly after the webinar. If you are interested in applying for this program, the application process is quite straightforward. You apply online at www.ucc.ie/en/apply. Decisions are made on a rounds-based system, and the next cut-off date is the 4th of May. But I would advise you to apply online as soon as possible, as we will be closing the program as soon as it's full. First off, I'd like to introduce you to Dr. Fergal O'Connor, the Programme Director of the MSc Finance, Banking and Risk Management, and Professor Niall O'Sullivan. Thank you so much today for joining us, Fergal and Niall.
Thanks, Trish. Thanks for the introduction. So I'm going to start us off by talking a little bit of the program structure and maybe a tiny bit of the job opportunities that come from the program structure. The Masters can be roughly divided into kind of 3 streams for your study. So the Masters is housed mostly in the Economics department, with some teaching in the Accounting and Finance department as well. So the core of the program, as you'd expect from any MSc Finance, is finance, right? And the modules that you would study there would allow you to develop a specialist knowledge around issues in asset pricing for bonds, equities and derivatives. So a good overview of all the main asset classes that you'd be dealing with if you went on to work in finance. On top of that, we teach a specialist module in treasury risk management. We're really lucky in the department here in economics to have 2 former treasury risk managers. So they discuss how companies manage their risk in terms of cash flow, in terms of interest rates, exchange rates, with a nice practitioner perspective in there. So the first stream is really the core, which is finance, and develops that knowledge. The second stream is, I suppose, because we're in an economics department, we focus on macroeconomics there. We talk about macroeconomics in terms of international finance, which is where exchange rates come from, how they develop, how they change. We also talk in there about crises, which are particularly relevant since the global financial crisis. But again, how COVID affected financial markets will be a big topic going forward in those type of modules. On top of that, we talk about how banking functions in there as well. So there's a lot of discussion of why banks exist, how banks work, and another specialist module then on regulation. And a lot of that module will focus on the regulation of banking and how that's changing in terms of Basel III and things like that, moving on towards Basel IV. So they're the 2, I suppose, the 2 corners of finance and economics that are covered, the macroeconomics. On top of that, we have a third stream with it, which is essentially, I think, you describe it as quantitative finance. So we have 2 modules in there which cover econometrics, which some students might have seen in their undergrad, some might not have. And those 2 modules, the first one is an introductory one, so we start from the very, very beginning, and we develop you through from first module, which is quite general and teaches you about how statistics can be applied to economic and financial markets problems, to the second module, which is then more advanced and more specialised around statistical issues in finance. One change we're making for this year, following discussions with kind of industry partners, people, and academia as well, to be honest, is that we are changing how that's taught a little bit. We're introducing a more relevant programming language, something that's much more in demand in industry. So from what we've seen of the research of job sites and things like that, we'll be introducing either Python or as a programming language, and that's how that data analysis will be done. And those two programming languages are relevant for jobs outside of finance, not even within it. So there's a nice transferable skill in there. That quantitative study then, developing your statistical mathematical knowledge, will allow you to go on and do another nice part of the Masters, which is what you do over the summer, which is an independent research project. So during your first 2 terms, you'll be seeing the type of research that the academics are doing here in Cubs, and doing a specialist module with Professor Eleanor Doyle on research methods, which is how you work out what to do over the summer. So how you come up with an interesting question that you can answer that hopefully will be of relevance to financial markets participants or kind of banking or regulation aspects as well. That project is individually supervised, and you do it by yourself. But the way the Masters functions in normal times outside COVID is there's a specialist computer lab dedicated to the MSc Finance, Banking and Risk Management students. So you're doing an individual project where you have that support of your peers who are doing the same thing over the summer in a shared space, and you also have individual supervision from an academic in the economics department. So someone like myself or Professor Niall O'Sullivan will be speaking with us here in a second. Those lead to a kind of a nice range of jobs as well. The first stream around finance would allow you to do, within reason, almost any job within financial markets. So investment banking, trading, fund management, portfolio management, the focus on risk management that you get within the treasury risk management module also opens up those kind of risk management jobs for you as well. The quantitative skills that you develop in the quant finance stream of the Masters would also give you a nice advantage in getting those jobs, and when you get in there, being able to give added value to the people that you're going to be working with and working for, and something nice and specialist to talk about within the interview, that you can bring that knowledge of a computer programming language like Python or into those roles. What's, I suppose, a little bit unique about this Finance Masters compared to some others you could study in Ireland or abroad would be that because of the emphasis on international finance and macroeconomics that goes in there and the kind of banking side, you can also move into regulation. So regulation and policy. So we have a specialist module on regulation, like I said, and we have a number of students every year who would go off and work in regulation, central banking. And one of our speakers, one of our past graduates who's speaking there now, we're very lucky to have Kathryn with us to talk about her job, her role that she's had in the ECB in that vein. On the quant finance side, there are specialist jobs within finance then that will be open to you that you wouldn't be open if you hadn't done advanced study in econometrics or quantitative finance. And those jobs, quantitative analysis in banks and hedge funds, but also some of our students, maybe one every second year or so, would also go on and do further studying, want to do a PhD in finance, and that background knowledge in econometrics and programming will give you a big head start if that is what you were interested in doing. And we're lucky again that one of the 2 speakers that we have, past graduate speakers that we have for the webinar today, John Twomey, that's his role. So he's a quantitative researcher at a hedge fund in Dublin. So there's a nice array of jobs in there that come with these 3 streams, and there's a diversity within the study, I think, that you do, even though it is a specialist finance Masters. We can bring in Professor Niall O'Sullivan now as well. Professor O'Sullivan founded this Masters. I am also a past graduate of this Masters, and Niall founded this Masters a number of years ago. And Niall, so obviously you're an academic now, but in your previous roles, you were an economist at Bank of Ireland, a treasury risk manager. And how would you say this? How would this Masters prepare our graduates going forward after they leave us?
Well, I think, Fergal, you've given a really good description of what comes up in the programme there, and what strikes me from what you say, I think, is obvious enough, and has always struck me when I consider this programme relative to others that I've come across out there in my career in terms of dealing with other universities and other business schools, is the breadth of the programme, the breadth of coverage in there. I see a lot of programmes that are kind of much more narrowly focused, but what I like about this one is that you can think of it in kind of 4 or 5 different areas. On the one side, you have banking and regulation is in there. The interbank markets, the money markets, how the relationship between banks and the economy, how banks are central, obviously, to financial markets as well. And then you have, in kind of that area as well, you have the link between the macro economy and the whole financial markets, capital markets, and how that is banking. And international finance, which again is all kind of in the same area, but look at international exchange rates and money markets and all that area. So that's in the programme. Then you've got fund management is in there as well, portfolio management and asset pricing, which looks very much across the broad spectrum of assets then, from primarily equities, but also bonds and other asset classes. So students are getting a kind of a thorough analysis of that. You mentioned quants, of course, which is great. The program is quite rigorous in that respect, and students will come out with good, strong quantitative skills. And I'm sure our 2 speakers in a moment will say how that's highly valued. And you mentioned, of course, which is very important to pick up on, that students come up with coding skills that have seen. So their ability to use things like Python or other software programs is so valuable to be able to speak about in interviews. I know from dealing in the Dublin market and the London market, for example, that you hear that all the time from employers. That's so important. And of course, not only in terms of your employment immediately, but coding is very valuable when you go on and do any kind of research afterwards as well. So that kind of the rigor, the quantitative side of the program is very valuable. Other areas, of course, are capital markets generally, bond markets, equity markets, all the asset classes, all in there. And you mentioned treasury. So treasury, again, in the capital market side, you've got all exchange rates is covered, money markets is covered. So a breadth right across the whole spectrum of finance is what I find, that I would say it's broader than the vast majority of other programs I've come across in this area. Now, and then, of course, right across all that is risk management. Risk management goes through, I think, virtually every module in the program. And that is quite deliberately why we don't have one specific module called risk management, is because it's everywhere. And that's why it's in the title. So it kind of permeates through all of the modules in one way or another. And again, I'm sure our speakers will speak to the fact that in the last, 30 years, financial markets have gone through more shocks than one would have expected in 100 years or 120 years. So, where the real value added is in financial markets nowadays is risk management. It's trying to not kind of openly predict the future. We're very dubious as whether that can be done, but it's to imagine what might happen in the future and to manage the risk around that. That's really where graduates can bring value added, I think. And so, consequently, it's that breadth of knowledge, and that breadth doesn't sacrifice depth either. I mean, the program is quite rigorous in all areas. It's quite a step up from undergraduate. That's what you expect at postgrad. It's it's a tough year, but it goes by very, very quickly. All the students will always tell you that it's where did the time go? So you're busy, but you're very engaged, and it's a learning curve. But at the end of it, I think it's probably one of the most productive years of your life in terms of education, what you learn. So yeah, I would say that it's both the breadth and the depth and the rigor that's there in the program. You come out with good quantitative skills. You won't be afraid. You'll have climbed one of the steepest learning curves you're ever going to climb in your life. So you're well prepared going into graduate work, I think, or graduate employment.
And I think one of the things just to pick up on there is some of the depth in terms of going deep into one area is what you choose to do yourself. So the independent research project, the dissertation in the summer, that's entirely chosen by the students with plenty of guidance from the academics through the modules and through the research methods module. But there's a lot of depth in every module, but then there's a lot of depth then over the summer where you pick a particular area you're interested in, whether it's capital markets, exchange rates, something like that, and you go into an awful lot more depth by yourself, over a focus period of 2 to 3 months.
Exactly. I mean, you get an opportunity during the course of the year to identify which area you're particularly interested in. So you get to choose your own thesis topic. It's not given to you. You can choose it. Then you're paired up with a supervisor who works in that area, who's interested in that area. And as you say, you get into huge depth there in becoming, you're really kind of reading a huge amount of what we call literature in that area that's been published and the work that's been done there already. You'll get into more coding skills, more quantitative skills in that area. And of course, also there's the fact that we aim in the dissertation. Dissertation sounds like kind of an old word, really. It's moved on from thesis to dissertation, but we're really focused on publishable, I should say, papers. So which gives you the, you're going to have the skill to write and conduct research to publishable level. You'll learn the skill of writing very concisely. The whole thing will be 20, 25 pages where we're moving towards, but it's not that's a concisely written piece of work. So you'll have good, excellent report writing skills at the end of all that. Out there, I'm sure our speakers will speak to the fact that nobody wants to read 150-page dissertations. Nobody has the time to do that. And so it's a skill in itself to be able to write very concise reports that grab people's attention and convey what you want to say very succinctly and concisely. So all those skills come through. You're getting a breadth of knowledge, you're getting quantitative skills, report writing skills. And as I say, it's a steep learning curve, but everybody comes out at the end. All students we've ever spoken to are delighted at what they've learned in the course of the year, how they've developed personally in that year.
And one thing I meant to say in my intro, but I missed, was that this program was developed with industry partners, back when it was developed in the first place, which is why that breadth is there. But we've there's continued engagement with industry professionals such as John and Kathryn who we're speaking to today, but discussions with them are why the program is changing now, and that way we're bringing in a programming language. So we are, the links to, a lot of the academics teaching on the program would have maybe industry experience before they came back to academia, and then there's people like myself who've been an academic from pretty much the beginning, but work in consultancy roles with finance partners, banks, people like that. So there's a lot of practical knowledge built in, and when as someone who's been taught by some of the academics on the masters from when I did it, one of the things that I would have liked was the practical application. When someone like yourselves talks about treasury risk management, it's from a practitioner perspective. It's not a textbook perspective. There's both in there. There's the academic rigor layered over with why you would want to know this. Yeah.
And I think finance is one area generally where actually the gap between what you want to call academic work and what some people call in the real world, so to speak, is actually quite narrow. Unlike other social sciences, I think the academic work in finance is very practically oriented. So having worked on both sides of the fence myself, so to speak, I often found a little bit when I was working that you're in Bank of Ireland or elsewhere in a trading room, there's an element of firefighting to it. You're kind of just responding and reacting all the time. And one of the reasons I wanted to get into do sort of more research is to be able to stand back a little bit and do kind of broad analysis, kind of a forest and trees, I suppose, really, and being able to do broader work. But I can certainly see that the gap is very narrow between the two of them. And then the one thing that me, again, kind of bridging that gap is risk management comes through the core and everything. I know both speakers having spoken to them before will agree with this, that traders and portfolio managers who take raw, open bets don't last very long.
As we've seen in the last few weeks in financial markets.
Exactly. You have to take, for want of a better word, educated investments, but you're very, very conscious of risk all the time, and very conscious of being put strategies in place to semi or partially hedge your position, and so on. So. And I was very conscious of that, both kind of on both sides of the fence, the practitioner and academic side, and I've always been struck by how narrow the gap is between the two. And that's reflected, I think, in the fact that within finance, there is a lot of respect for academic work, and there's a lot of collaboration between the two as well. And that's why virtually every single module in the program will have guest speakers. That's a huge feature of the program. And the strength of that then is that whatever is particularly topical that year, if there's something going on in regulation or central banking or hedge fund management, you're getting absolutely cutting edge talks on that. Which of course then means when you go into interviews yourself, just a matter of weeks or months later, that's all very fresh in your mind. So you're able to converse in the language of financial markets fluently from the off. All strengths.
So, yeah, and so to follow on to that, without further ado, we will bring in our first guest speaker. So if we'll speak with Kathryn Prendergast. Kathryn did the MSc Finance back. It had a different name back in the day when I did it, and when Kathryn did it. Then it was the MSc Financial Economics, but it's the core of the program. Those three streams still exist. So, Kathryn, we'd love to hear a little bit about your career, what you've done since you left the Masters, and how the Masters affected your career, I suppose, because you did an undergrad in UCC as well, BA Economics, and then you went on and did the Masters with us after that.
Sure, thanks a million, Fergal. And I suppose firstly, just to say thanks to yourself and Niall for inviting me here today and giving me the opportunity, I suppose, to talk through my career to date, and specifically, I suppose, how specifically the Masters has really, I suppose, facilitated me and, over the different roles that I've held, over the last 12 years. I think Niall touched on it there, and I suppose looking back, what has really struck me and what has proved extremely beneficial, from the Masters has been, the wide variety of topics and areas covered during the Masters program, and the breadth of topics which really, coming out as a graduate, offered a number of different career paths and opportunities to me to pursue. So I think, as you can imagine, graduating in 2008, it was a very challenging economic environment, and by default, the jobs market, was quite challenging as well. I think, looking at the Masters also, I would highlight, there was a very good mix of quantitative and qualitative topics covered, which I think, looking back, has proved very beneficial also, and I've been able to apply the different modules to different roles that I've held, over the last 12 years. So after graduating in 2008, I took up a role in March 2009, initially with the Central Bank of Ireland. So for the first 4 years there, I worked on the economics side of the house within the Central Bank, specifically in the Economics Directorate. My role there was really working as a research assistant within financial stability. I worked there for 4 years, and I suppose, that role in itself was very much, adopting very much a macro analytical view, monitoring and assessing the evolution of different sectors, across the Irish economy, and very much from a macro level. I worked there until 2013, so I suppose what I would highlight, during those 4 years, and what was very beneficial, from a learning experience also, was, as you're aware, Ireland were obviously going through the economic adjustment programme during that time as well. So, it was a very, very interesting, start to my career, and it really allowed me the opportunity to develop, I suppose, the skill set and the knowledge that I had been exposed to on the Masters programme. In 2013, I moved across to the supervisory arm of the Central Bank, into banking supervision, where I spent 2 years. So my role there was in a supervisory capacity, so supervising and being a member of a supervisory team from one of the credit institutions operating in Ireland. I suppose one of the outcomes of the 2008 financial crisis was the establishment at a European level of a new entity, the Single Supervisory Mechanism, or the SSM, which assumed its powers in 2014. And really, the objective of the SSM was to, assume direct supervisory responsibility for the largest and most systemically important credit institutions within Europe. So I actually moved to Frankfurt in January 2015, and I worked with the ECB in the SSM for 4.5 years. So, very, very positive experience, a number of really interesting projects. I had exposure to a number of different projects during my time there. I had the opportunity to go on site within the banks themselves and participate in the stress testing programs. So, very, very interesting experience. And I suppose during that time, I continued to develop, my own skill set and apply, different topics that I had been exposed to on the Masters programme. So I was 4.5 years there, and I suppose really that allowed me also to get exposure outside the Irish banking sector and to other banking institutions in other European countries. So that was very, very positive. 2 years ago, just under 2 years ago, I returned to Ireland, to Cork, where I again moved sectors. So I moved into the MiFID space, and I have been working for nearly 2 years until recently in an investment firm based in Cork. So I suppose again, that allowed me to get exposure to a different sector, a different piece of the regulatory environment, and the space.
So regulating investors as opposed to banks, I suppose, is the big change there, right?
Exactly. And I suppose getting exposure to different type of investment type activities and services, and getting exposure to a different regulatory landscape from which I had been previously exposed to. I think from my own perspective, I suppose the masters really gave me a foundation, from which I could build on and continue. I continue to build on, during my career, on the different topics covered. And I think, a big benefit has been, the wide variety of topics which we would have covered. And I think definitely the mix of the quantitative and qualitative type of subjects that we got exposure to.
Yeah, I mean, one of the reasons I was so interested in getting you to come onto the webinar was that kind of diversity of experience. That it wasn't, working at BCB would have been enough that I would have wanted you back. But it's nice that you were, you can show that you're able to move between those spaces as well. So I'm gonna hold on to you, Kathryn, and we'll bring you back in for the panel discussion in a few minutes' time, if that's okay. But before that, we have a second graduate of the program who has gone on to do quite a different role. So we'd like to welcome John Twomey as well, who is head of research at Abbey Capital, a hedge fund in Dublin. John did the masters as well, and I suppose it's a very different role you're doing, John, to Kathryn, even though you've both done the same masters, and you were an undergrad BSc Finance at UCC as well. So I'll let you take it away and tell us a bit about what you've done, and again, did the masters, how did it contribute to that?
Of course, and thank you, Fergal and Niall, for having me back to speak and to give my thoughts and speak about my career. I appreciate the opportunity. I suppose just from my perspective, as you said, I did a Bachelor of Finance as my undergrad. My kind of experience in finance goes back a long way. My mother was a secondary school teacher of business studies. So we've always been, I suppose, as a household looking at financial markets, and it's always been in my world. And it was a pretty natural transition to go on and kind of do an undergrad in a business related subject, particularly finance. And but when I was doing the course, the undergrad in finance, I think what particularly was interesting for me was the final year of finance, where things started to get much more focused on some of the topics Niall had mentioned there earlier, things like capital markets, derivative instruments, actually how people go about investing, how they go about putting money to work, and how people go about hedging back and risk managing those investments as well. So in the final year of kind of my finance course, those sort of topics, along with things like portfolio construction, started to really come to the fore more and more. And as I finished that course, I was looking and I was wondering what was the next step. And I decided to come back from a master's, and while looking around, I suppose I found the financial economics masters at the time, which was very much focused on a lot of these items. And yourself and Niall mentioned them earlier. Kind of things that appealed to me at the time were that direct industry link, right? The practical side of things, how things link back into actually practically putting on a position for an investor, or or how entities are actually really regulated in practice. So that kind of that bridging the gap between theory and practice was quite interesting for me. And so that's why I chose to do the course. I would say that my experience personally of the course was one of an incredibly collegiate environment, a relatively small class size, and the ability to speak at length with the lecturers and the industry speakers that they would bring in. And I think that to me is one thing that always stands out. And Niall mentioned it earlier, that ability to be up to date with what's going on. When we were doing our masters was, it was 2007 and 2008, so an incredibly volatile period in markets, across that period of time. And you had a lot of stuff coming on a daily basis. So hearing people actually in the market speak about what's going on, and then being able to go up to them at the end of class and discuss it was hugely valuable, and something which I felt was very useful and formative for me. Two things which really stood out to me, and I think Kathryn mentioned it earlier as well, was kind of the technical skills that we had and we brought from the masters. I think the grounding in econometrics and statistics from a really deep level was hugely valuable to me anyway in my own development. Where I work today, there's a great concentration on kind of quantitative techniques. I suppose everyone's aware of how more readily available data is today compared to how it was. It really is the lifeblood of finance and the lifeblood in the investment world, data. And to be able to properly interrogate that data and come up with statistically robust conclusions about it is hugely valuable. And that's one thing I think which we've seen, particularly over the last sort of 10 to 15 years, has been an increasing quantitization of finance, right? The need to be able to be data literate is hugely important. And Fergal was speaking, you were speaking earlier about the kind of the need to be also, have programming languages, right? Have those technical tools to be able to deploy that. So not only to be able to talk about it, but to be practically able to do it. So, I felt from my own experience on the course, even back in 2008, the key cornerstones of that were in place and were hugely valuable to me as I progressed in my role, which is quite quantitative, I would say. The other thing which I found hugely valuable from the course was the thought or the thesis, the formal thesis or dissertation, as Niall mentioned earlier. And that was really interesting as an opportunity to kind of translate ideas, things we had discussed in class, things we had heard from lecturers, things we'd heard from some of the industry people who'd come to talk to us, and actually put them into practice. And Niall mentioned earlier as well, the ability to succinctly put together a point, not to say everything about it, but to be able to put down on paper the key points. And that's something I think as well that did serve me very well as I went to interview. And my first, just to kind of move on from there, my first interview proved to be the one I'm still in. So I joined I joined Abbey Capital in 2009. As Kathryn said, I was in the same class as Kathryn and yourself, Fergal, and we graduated in 2008 in the midst of the financial crisis. And I think it speaks to the strength of this course and the material that we were taught, that we were able to go on to very productive careers afterwards. My first role was as a research analyst at Abbey Capital. Abbey Capital is an Irish alternative investment manager, focusing in on kind of active fund management and things like managed futures, macro strategies, and so on. So, from an investment perspective, you need to be able to obviously analyze the data that comes to you, but you also need to be able to effectively tell people what that's about. What is the investment about? What is the core thing we're discussing today if it's about a particular meeting? So today, I started as a research analyst at Abbey. Moved on to become a senior research analyst, deputy head of research, and became head of research at Abbey Capital in 2014. I'm a member of the investment committee at Abbey Capital as well, the decision-making body within the investment firm. And my team, the research team, really are responsible for most of the investment side of the house. So from kind of selecting new investments, putting those together in a portfolio, and then monitoring them over time. The majority of our investments tend to be on kind of the more quantitative side, so quantitative strategies. So being able to talk the same language as some of these incredibly quantitative hedge fund managers out there is an important part of that, to be properly versed and properly able to understand what somebody means by some sort of advanced time series analysis is important for you as an investor making that final decision. And for me, it is kind of a culmination of a lot of that work we had done in the masters and seeing it kind of in practice in the real world as as an end investor?
Yeah, look, it's from discussions with people like yourself and Kathryn that we're, you know, the core of what you're saying there has stayed the same in the masters. I suppose the three streams and the theories underlying theories are there, but what goes on top of that in terms of skills or what we're updating in terms of Excel skills, but also, you know, following discussions with a couple of people such as yourself, the need for a programming language. So we want to layer that on top, and because, you know, when we did it, we were doing what was the current, you know, one of the more common languages at that time for stats. But, you know, things keep moving on, so we keep trying to adjust. So I suppose the core is the same as what you would have studied in some ways, right? But the material gets updated, and, you know, the skill set that maybe graduates need coming out, and that's why we're trying to react to things like that. And let Trish come back in now with that. That's okay, and we'll move on to our next phase.
Kathryn and John for sharing some great insights there. All our speakers will now return to discuss some broader issues in the financial sphere now. Just a reminder, if you have any questions for any of our speakers, please let us know through the YouTube comments.
So I might just come in there. Thanks to Kathryn and John who discussed their career paths and struck me as, it's like different career paths throughout to the world of financial markets. And we were talking in advance about, despite coming from different career paths, one thing that is important to both of you in your jobs, perhaps for slightly different reasons, is the fact that we're operating in a negative interest rate environment. I'm a good deal older than my two speakers here, but when I was working in financial markets, negative interest rates just didn't even if somebody said to me the interest rates could turn negative, I'd be scratching my head and saying, how on earth could that possibly happen? Going back, I think, to the days of Adam Smith or something, somebody would say that's impossible. But it's happened in recent years. And I suppose one thing so we're not going to have a kind of a discussion about the negative interest rate environment, because we could focus on something relatively narrow at the moment, like COVID or something, but negative interest rates have been around for longer than that. And so it's kind of a big issue that's been going on for several years now. So just briefly to mention what negative interest rates are and how they come about. So a negative interest rate essentially means that if you were putting money on deposit at a bank, you're paying them to keep the money. Now we don't have negative interest rates at retail level, but essentially that's what it means. So at a kind of an interbank level or in a financial market system, you're paying to park your money somewhere rather than receiving an interest on that deposit, which is, again, very unusual. So how has this come about? Well, I suppose this really began moving in that direction from a number of speakers have mentioned the whole 2008-2009 crisis, which plunged much of the world into recession, and central banks would have a role to play in that, and monetary policy would have, and so interest rates began to fall from around then, certainly in the European Central Bank level, and also the Bank of England and the Fed, and interest rates went lower and lower in an effort to stimulate the economy. Of course, when interest rates are lower, it's cheaper to borrow money at the corporate level, at the retail level, and so on. And that is, in theory, supposed to spur economic activity and help to slow down recession or even pull us out of recession. Didn't really work very effectively, and so interest rates went lower and lower and lower, and eventually kind of reached zero, combined with quantitative easing as another method of trying to stimulate the economy. And then somewhere around, I think around 2014, 15, went into negative territory. So for banks to deposit money with the European Central Bank, at the deposit rate would have been negative. So they said the ECB was actually charging banks to deposit money there. And so we've moved into that environment for quite a while now, and even yields on some bonds, even German bonds, even Irish bonds, are negative. And so it's a very peculiar environment that we're in. And so I thought it'd be very interesting to get the perspective, two different perspectives, one from a banker, as it were, and one from a fund manager, on how that affects you, what's your thinking on it, and how it impacts your job. And I suppose that John is a fund manager, but Kathryn also very much involved in international central banking. Both very preoccupied by this, I would imagine. So maybe if I hand over to Kathryn first. Kathryn, you're, or am I? No, sorry, John first. John, just what's your perspective?
Yeah, and thanks. Yeah, no, absolutely, and it is something that is very topical at the moment. And you know, while it has been around for a while, this environment we've been in, I think it is coming a little bit to a head at the moment, and you're seeing that with some of the volatility in the bond markets, if people are familiar with, over the last sort of 6 to 12 months. I suppose to start as an investor, you've got to think about why this is important to you, and I think you've got to think about what the typical investor tends to own. So that comes back to kind of the core idea that has dominated portfolio construction and most asset allocation schemes for the last sort of 20 years, which has been this concept of a 60-40 portfolio, right? So you have 60% in your equity side of your book and 40% in bonds, and typically government bonds, sovereign bonds, high-end corporate credit, things like that. So that asset allocation plan, simple as it may be, has been incredibly effective for investors over the last 20 years, but particularly the last 10 years. You know, when you look at the sort of figures that it's been annualizing, you know, investors have been able to get a 10% return with a 60-40 portfolio at half the volatility of equities. So it's been an incredibly attractive, incredibly easy place to be. And that's been driven for a number of factors, as you're kind of alluding to there. Our starting point in 2008, 2009 was incredibly favorable for this portfolio. So yields were at a respectable level, a couple of percent, but also equities were at incredibly good valuations. I think the PE and the S&P was about 15 in 2009, 2010. So it gives you a sense of where we're coming from. And the last 10 years has been very, very attractive for that portfolio. You've had quantitative easing, you've had low inflation, and you've had very steady economic growth along the way. So it's been a kind of a little bit of a Goldilocks scenario for those types of portfolios where kind of everything is working. It's working for both the bonds and the equity side of your portfolio. And through that time, there's been a nice negative correlation between equities and bonds. So you've been in a situation where, I suppose, when your equities have tended to sell off, your bonds have rallied, and that has reduced the volatility of your overall portfolio. So it's been a very nice place to be as an investor. Now, as you kind of alluded to, kind of things have changed, right? So we're in a world now of where rates are really locked at low levels. So not only at the front end, but also kind of 10 years out as well. So it's now a picture where we're seeing, you know, low bond yields across kind of the developed world. And as a first point of call for an investor, you think about what your return on the various assets are in your portfolio. And typically, starting bond yields are a very good predictor of future returns. So the fact we're starting with kind of bond and interest rate levels at close to zero means you can probably expect close to zero or very low return on the bond part of your portfolio for the next 5 to 10 years, which is obviously a difficult thing for people to get their head around. And at the same time, you're also, not only has your return been dampened, but your risk has gone up. As rates have gone down, your duration risk in your portfolio has gone up. So your sensitivity to interest rate moves is higher than it was historically as well. So that's a really bad, I suppose, combination for an investor who's thinking about my return has gotten worse on this asset and my risk has gone up, thinking about the risk management side of your portfolio. So overall, the risk-adjusted return or the risk-adjusted expectation for it is poor. And kind of the kicker to that for people who are investing in the space is that there's a possibility that that negative correlation that's been there for equities could go away. And you're in a situation where suddenly we're in a situation where when equities go down, bonds go down as well. And from that perspective, you know, we could easily see a situation where bonds are additive to a portfolio risk rather than subtracting from it.
So if I'm going to throw it across to Kathryn a little bit here, because from what John is saying, you know, and everything he's saying makes sense to me, to be honest. You're looking at it going, who's going to buy these bonds? It sounds terrible, and yet last week the Irish government borrowed 10 years. They borrowed for 10 years. The interest rate I think was about minus 0.6%, and there were 2.5 times more people. The money on offer was 2.5 times more than what they wanted. So to throw it across to Kathryn, like who's buying these bonds? And I know the answer is partially banks, but why would a bank buy something which is guaranteeing them a loss, right?
Yeah, and I think, it's obviously such an interesting area, and it's such an interesting question because, again, the rationale for banks continuing to buy up government debt in such a low or negative interest rate environment. I think, the natural question is why. I suppose, the own viewpoint maybe I'll just add to it is very much from the regulatory central banking side, from a monetary policy perspective, and maybe just to highlight, I suppose, firstly, from a regulatory perspective, the value in banks in particular holding these type of assets on their balance sheet. Since I suppose the 2008 financial crisis, there has been significant changes, evolution in the regulatory framework. I think particularly from a liquidity risk management perspective, banks are now subject to higher and specific and newly introduced liquidity requirements. Specifically, they are required to hold certain type of liquid assets to ensure that they can meet expected cash or liquidity outflows over different time horizons. So, I think the first factor to highlight is that typically government bonds tend to qualify as high quality liquid assets, thereby facilitating banks in meeting their regulatory liquidity requirements. Additionally, from a capital perspective, banks are required to hold certain minimum level of reserves to ensure that they can absorb unexpected losses which may occur on their balance sheet. Typically, government bonds tend to require banks to put aside very little or zero capital charges against government bonds. So again, I think that's another important factor to highlight, the attractiveness of banks holding these types of assets on their balance sheets. So, from a risk management perspective, specifically liquidity and capital planning, they are very, very important factors to consider. I suppose thirdly, I would highlight, from obviously a central banking side and in terms of facilitating banks in accessing funding facilities available from monetary authorities such as the ECB. Government bonds typically tend to offer banks the most attractive and the optimal level of funding from monetary authorities, because they tend to have the lowest levels of haircuts applied to the collateral which they have to place with the central bank to access lending facilities. And obviously facilitating banks in accessing central bank funding is extremely important, particularly during times of crisis, as we've seen over the last year with the COVID pandemic. And I suppose the use by banks of government bonds in terms of pledging them as collateral with the ECB to get essential funding lines. So I suppose my own view is obviously that this will continue. Banks will very much there will continue to be a demand by banks for government debt, even in the low interest rate environment currently prevailing.
Yeah, so look, it's a difficult place for banks to be in one when you think about it. You don't normally give too much sympathy to banks, but they're required to buy bonds by the regulatory authority, and and a similar government policy and central banking policy drives those down to negative, so you have an increase in your costs. So yeah, it's interesting how it all links together. And I suppose one thing to highlight maybe at this point is I'm really grateful to John and Kathryn, who both offered that they might come back and give guest lectures next year. So things like regulation in particular, really important to get people in who are doing it, because it's always changing. Basel III and all these regulations are constantly evolving. So it's great to have Kathryn. Kathryn has suggested she might be able to come back and join our regulation module with Dr. Allocation, and John has said that he'll be coming back as well to talk in terms of investment and investment evaluation with modules. And I thought maybe a module that's taught even by Professor Niall O'Sullivan there, one of those modules. So just to throw that into the discussion at this point.
If I could just bring very briefly to both Kathryn and John. We were in this environment for 5, 6, 7 years or thereabouts. Do you think it's the new norm to hang around for a while, or do you stand back and see the big picture and think this is a it's temporary to some point? But when do you think it might come to an end? Like, are you living this day to day, or are you thinking it's the new norm, or are you thinking it's a temporary thing that we're going to move out of, and when? How do you view that? What's the background view to that, so to speak, in your organizations or in the markets generally?
I'm happy to start, Kathryn. If you want to join in at any point, please do. I suppose one of the things we often think about is, and you mentioned it earlier, is in risk management, it's about thinking what could happen, right? And what could happen going forward. And I think that we spend a lot of our time thinking about those various scenarios that are on for our investments that we hold. And, you know, one of the things which is, I think I've learned definitely in finance, is that the prevailing environment is a prevailing environment for a period, and then it can suddenly shift and change quite rapidly. You know, you've heard of these concepts like Minsky moments and things like that, where things suddenly change on a dime. And I think that's the potential for what we have now. We've had an external force in the case of the COVID pandemic, which no one could have predicted going forward into this particular market environment. And it's had some pretty extreme impact in terms of monetary policy, the view on fiscal spending in various countries, the direct, I suppose, the direct stimulus that you're seeing in the US with actual stimulus checks being put into people's accounts. So from that perspective, things are quite different than they were 18 months ago, 2 years ago. You know, a lot of stuff has happened in the case of kind of a year. And I think you're starting to see some of that already play out. And the big thing that could change everything for everybody is inflation. So we haven't seen inflation for decades now, really since the early 90s. We haven't seen inflation being a major impact in kind of developed economies. We've been fighting to keep it higher. As a result of that, that's kind of, I think, for me, the key kind of inflection point that could see things change quite rapidly. And you might even start to see this in the US at the moment. Yields are back up at what, 1.5%. Inflation break-evens are high. So from that perspective, you know, that's the big unknown. Will we see that inflation coming out of the pandemic?
I think maybe John, just to add, I suppose, I think, you know, you touched on it as well. I think, you know, in terms of the preparedness, and, you know, I suppose no one has a crystal ball in terms of, you know, looking into the future. But I think, you know, I definitely think from the regulatory perspective and the changes which have occurred since the last financial crisis, it's ensuring that the financial services sector is prepared for different scenarios which may materialize over the coming years. And I suppose that's having in place, for example, you know, adequate stress testing framework, for example, you know, in place internally, you know, to assess, you know, the adequacy of, for example, capital liquidity, you know, under sets of different scenarios. So I think it's, you know, I think my own perspective is, you know, that's where really a lot of attention has been given to as well since the last crisis, to making sure that, you know, the financial services sector has that, you know, internal framework in place to assess the preparedness of the institution for different scenarios which may materialise.
Yeah, and I mean, COVID has stretched the banks, and, you know, it's not over yet, but so far it does look like the reforms after the global financial crisis have improved, you know, bank stability and things like that, I think. Listen, thanks to everyone for all the contributions so far. I have one question that's just come in, and if people have more questions, throw them in while we have time. Someone's asked, do you think it's more difficult to break into investment roles as a graduate? Might you have to build experience in other areas before you transition into investment? So I'll give a brief one, and let any of the three that wants to add to it. You definitely don't need to do another job before you go into investment. So a lot of our graduates go directly into investment banking roles, asset management roles, you know, directly, and central banking roles like Kathryn did. So directly into advanced roles, and that's the purpose of the masters, so that there isn't a big delay. There's a lot of graduate programs to apply for in corporate banking, investment banking. What I'll say is within the masters, we'll be encouraging you, if you join, to get on those applications really, really quickly, because they tend to be pretty hard and fast before Christmas. As part of the masters, and I suppose we'll all come to masters, not just this one, you have access to the careers office, and they give you advice on CV prep, interviews, and you're allowed, you know, you have access to experts there on a one-to-one basis to make appointments with them to do that. So I wouldn't say that from my experience of graduates and my experience of my friends who I got back today to do the webinar with me for my masters, there was no need for a role somewhere else or something like that. You are prepared by the masters to go directly into a graduate role in investment banking, asset management, trading, central banking. There's the list there on the website. I don't know what other people would like to add to that, really. Would you agree? I suppose.
Yeah, I certainly, from my perspective, I went directly from the masters into an investment role, a research analyst role. I think you have the core skills coming out of it, and I think that's the important thing. That's what employers are going to be looking for is kind of those core skills. In our world, a lot of it comes back to the quantitative side. I think across all of investment banking and in the investment world, that is becoming more and more important, having those quantitative skills. And then being a good analyst, having attention to detail, being a good report writer, and something like the thesis, I think in particular will stand, or the dissertation as it's called today, will stand very strongly to people coming, because they'll be able to show to prospective employers kind of those skills in practice to a large extent.
And look, just come back to the students. Some of it is self-selection as well. These are high-paying roles, so there's a lot of people are trying to get them. So it's about persistence and getting good prep in before your interview and making sure you'll be doing a lot of applications to graduate programs, maybe, and being attention to detail, which again the masters is there to help you develop, but making sure you're answering the questions that are asked in the interview questions. In the same way when you do an exam or an assignment here, we focus on making sure you answer what we are asking you rather than telling us what you know. So yeah, I think that's I don't think there's any other questions coming in. So look, thank you to everybody for volunteering their time today to come back and speak, to Niall, to John and Kathryn, and thanks to John and Kathryn as well for volunteering to come back as guest speakers, with specialist knowledge for the masters. We're really grateful. They're not the only two, but they're the two, I suppose, that were here today. But we will thank everybody as they come through during the year. And I will pass it back to Trish, and thanks to Trish and Aoife in the background for organising all this. We're really grateful to you as well.
And just echoing thank you to all the guest speakers and the panel for their time and engaging with the event today. And I'd also like to thank our Cubs media team who guided the panel so expertly through the event. Just a reminder, really, guys, next Thursday we have another postgraduate webinar for those looking to start a career in business analytics. That's with the Business Information and Analytical Systems program and the MSc in Cyber Risk for Business, or two specialist programs in business information systems at Cubs. And finally, I'd like to thank all our viewers who registered and attended and contributed to the event today. And I'd like to wish you the very best of luck with your application. Thank you.